Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be stories or narratives that can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal as well is to break down all the market jargon and complexities really that you read about. So if you do have any questions along the way, please do ask them and I'll try and answer those as quickly as possible or as best as I can, at least during the webinar or when the webinar finishes. Okay, it's just after 11 o'clock in London, so let's kick off. Markets this week generally are up really since the quiet rollover from last week. Obviously, US participants were away with US President's holiday. I'm going to just start off with a chart that we don't often look at, which you can see here, which is the 2-year US Treasury yield chart. But before we get into that, just markets in general then really picked up since yesterday. Really, the global activity surveys for each region really informed on the latest state of both manufacturing and services activity. And they really built on that improvement which we had seen for the first time in months in January. Of course, the risk rally, that did a sharp about turn as markets really worried about higher rates. And we could see really on this chart, if I just scroll in here, let's just take off some indicators. Let's count the channel. So you can see really that we're pushing up to this well, near new cycle highs really, and we've closed making cycle highs actually above that November high, but the spike obviously at 4.88% for the 2-year Treasury yield. I just focus on this bond, this Treasury, because it most closely follows the Fed funds rate. And the theme that we really want to get into is this theme around the story around higher rates for longer and how the market has really caught up with what the Fed has been saying for quite a while. There's been that divergence between views, but now the market is rushing to catch up. And as I say, we can see that on this 2-year Treasury yield, we can see a sort of dipping below sort of 4.3% or so, getting towards 4%, and then this big move higher. Really, since February, you can see this month big in yields. That means prices falling. Prices fall as then yields go higher in fixed income markets. So just looking at the theme then, really this theme around the dollar rebound and also around, as I've said, this higher for longer idea with interest rates. We've consistently been highlighting that disconnect, as I've said, between what Fed officials are saying, what the markets have been thinking, and it's been then around looking at data, this idea of data dependency. And if we just remember, after looking, well, slightly comatose really in the US economy in November, December, the US economy really has picked itself up off the floor and come roaring back to life really in January. If we look at the evidence, well, that's come thick and fast. We obviously had that huge non-farm payroll headline number, 517,000 job gains. We had a 6-point jump in the ISM services to solid expansionary level of 55.2. We had stellar retail sales, though the weather probably helped there. We've had a surge in light vehicle sales as well. And even the troubled housing market and manufacturing sector had something to cheer about, with the highest level in one measure of home builder sentiment since last September. And even then, manufacturing production, that increased by 1%. And again, then we had more of the same of this really strong data out of the US, really globally, but the US we're focusing on here with the PMIs yesterday. The composite PMI that returned above that 50 plus mark, if you remember, below 50 is above 50 is expansionary, below 50 is contractionary. That PMI composite returned to above that line for the first time since June last year. And the spike actually came due to a similar move in the services gauge, while the manufacturing improvement was, well, a little more modest. So really interesting, just data upon data, really pointing to so many indicators, pointing, in the sort of same direction, which is very positive. If we just go to the tool, which we haven't looked at so often recently, but that is the CME Fed Market Watch tool. If you remember, if you've been following us for a while, we've looked at this through, probably not this year, but all the way through last year. Just to recap, the CME Fed Watch tool, you can get it online. It's a free tool by the CME, and it analyzes the probability of FOMC rate moves for the upcoming meetings. And just in the detail, then it uses Fed funds futures pricing, basically, which have been relied on really to express the market views on the likelihood of changes in US monetary policy. So it's a really good visualization tool, if you like, of both historical probabilities of various FOMC rate change outcomes for a given meeting date, and then also those current probabilities. A really simple tool to use. You can see the different FOMC dates coming up here. So the next meeting, 22nd of March, then May, June, July, through to the end of the year. And really, yes, just looking at Fed pricing, obviously most market participants really thought that sort of below 5% would be the peak rate, around 4.9%, if you remember. But really, since this data that we've had, this bumper data, along with, of course, as well, that hawkish Fed speak that we've been seeing consistently over the last few months, that's really driven this aggressive repricing of the Fed rate hike cycle. The rate hike peak now is towards 5.37% in August. And if we just look at, well, the July meeting, this is again meeting by meeting, so we don't have a precise top, if you like, in the Fed funds rate, but you can just see as a great example here. So I've said 5.36% is in August. This meeting is July. So just after the meeting, then pricing gets up to sort of this middle point, 5.37% or so. So that midpoint there, which is given a 48%. So a 50% chance, say, of that happening in July. And you can see here some of the historic pricing, really interesting, 48.7% now. Just go back a month and you can see that was priced pretty much, wasn't priced at all. And really there you can see just exactly what I just said. Price was below 5%. That was given, say, a 50% chance, 47.5% chance a month ago. That's now dropped to pretty nothing, and we've basically flipped. So we've sort of added in over sort of 40 basis points of tightening to the Fed rate hike cycle, where we get this marker now sort of 5.36 or so percent as being the peak rate, and that is pretty much an all-time high now in that peak rate. So just before then, so before we get to July, obviously the next meeting in March, 22nd of March, you can see now we've actually pushed up now. Pricing potentially a 50 basis point move, 25 basis point move is sort of 76% chance. You can, if you remember, we're 4.5% or so for the Fed funds rate, so going to 4.75 to 5%, that range, 76% chance. But now, sort of 3/4 of given to that, a quarter, so a 24 percentage chance, sorry, of a 50 basis point move. So taking rates to 5% and above. You can see again, even a month ago, we had no chance of that, and pretty much an 80% chance of a 25 basis point hike. Really interesting change here, and potentially that will move on the Fed minutes, which we'll get into in a minute. And then also some more inflation data, the PCE data, which we'll also look at briefly shortly. But yes, pricing really. So beyond the March meeting, then we also have another couple of 25 basis point hikes priced in. I've mentioned obviously that peak Fed funds rate at around where we sort of 5.37% or so comes in August. And then at the end of this year, so we'd have to look at, and we can't see it on this tool so much, but if you Google it, I'm sure you'll get it, as I have done. January, the Fed funds rate for January 2024 now is traded for the first time above the average Fed forecast for year end, which had been of around 5.13%. That's now hit 5.15% or so for the first time. Again, obviously in March, we do get that updated dot plot, the SEP, the projections, if you like, but that forecast was, as I say, a 5.13%, the middle of 5 to 5.25%. It was around that marker last time we had the dot plots, but now potentially that gets upgraded, of course, with all this really positive data. Just thinking about the DXY before we go to the chart, then we can kind of see that actually we'll not go to the chart. Actually, we'll go to we'll go to this week's data actually. So the Fed funds, the FOMC minutes, which is obviously what we get tonight, UK time, 7 p.m. The February meeting. The minutes cover the February meeting where the Fed, if you remember, chose to slow the pace of interest rate increases. It lifted the policy rate by 25 basis points, with the debate really moving away from the size of hikes to how many were left in the cycle. And interestingly, as we've just shown you on this CME Fed Watch tool, we're kind of slightly going back to the debate about the size of the hike again, with potentially that 50 basis point hike becoming more relevant. Just going back to the minutes then, the press conference in February, that was relatively relaxed. If you remember Powell, he said the disinflationary process had begun, but the FOMC would remain data dependent, with still not sufficiently restrictive. Of course, now that has changed slightly. The market's more sensitive to that 50 basis point hike, potentially, and then really it's around the sort of level of dissent that we might see in the minutes as to how many Fed officials potentially look to a 50 basis point hike in February rather than that 25 basis point hike we saw. And then obviously, as I've said, that has implications for the March meeting. Just 1 second, if you just bear with me 1 second. Just bear with me, sorry. Apologies about that, just had a slight technical issue, but yes, so just going back to the minutes, the Fed minutes released tonight UK time, Focus, as I said, will be on potentially the level of dissent. So anybody who's voting for a 50 basis point hike rather than that 25 basis point we saw. Of course, I've mentioned all that data, if you like, all that macro data, non-farm payrolls, CPI, retail sales, obviously the PMI data yesterday. And then obviously the hawkish sort of tone that we've seen by numerous Fed speakers since the February meeting. So all of this February, obviously, we've had that data plus this hawkish tone. So it kind of might mean that the minutes actually, I know there's so much focus on it, but really the minutes now are really slightly outdated. If you think that we had all the data and the hawkish speak, although we have had that, of course, before, but we've had all that data after the minutes, after the meeting, really. So, and then obviously this peak rate pushing up towards sort of 5.37, towards 5.5%. So, yeah, just kind of wary that they might be dated, and really then that the bar, if you like, for a hawkish surprise is then slightly too high for the dollar to move, for markets to move much. We've obviously had that big repricing, as I've said. Upward surprise in data means this big repricing in the Fed pricing. And you kind of think then that it would really have to be really a sort of a big pronounced shift towards a 50 basis point hike in February to then move the bar, raise that bar, and then push potentially the dollar higher. Just looking then at, let's just go to the DXY chart. Just bear with me when I pull that up. So the DXY, obviously a basket of 6 currencies against the dollar, and just we can see then well, the dollar's regained some of those losses, obviously some of the heavy losses it took. Over 11% drop that was from last October. I think we've regained about a quarter of that sell-off now, but we're kind of, yes, we've highlighted before a couple of or this zone, if you like, 103 to 103.82 on the DXY. If we just pull back, we can see the pandemic top, really that spike top was at 102.99, and then we go back even further to this spike here, the end of 2016, start of 2017, that top was at 103.82. So you can see we're sort of traded below there, couldn't track really much below 101, and then we've put up 3 weeks now of consecutive gains. And just on the daily then we can see we traded around that sort of zone 103 to 103.82 for at the start of February. Then we've pushed up above, and we're sort of trying to track now above that support at 103.82 as we see it. Interesting, we think last Friday's price action where we did pop up to 104.66, and we couldn't close anywhere near there, although it was a positive week for the DXY, but we then closed below, and we're just sort of slowly edging higher, but sort of not tracking some of those bond yields that we've seen, which have pushed up really sharply higher, and especially the 10-year yields. If we just look at that chart, actually, the 10-year yields just generally seen as a sort of global proxy, if you like, for bond costs. You can see that's pushed up, especially yesterday on the PMI data, up towards sort of 4% now, a key level, having got past probably these December highs around sort of 3.9%. That's a sort of key resistance level. If we can close above there, then potentially we get towards the 4% level, key psychological level, as I've said. But it's sort of surprising for us in a way that the DXY has not really cracked last week's high, at least. 104.66, even with that push higher in yields. So as I say, the bar is quite high now for a sort of hawkish surprise, if you like. Also, we get the release of the core PCE deflator. That's the Fed's favored inflation gauge. Really, we get that release on Friday. I think month on month, 0.9% is seen in January. Annual rate seen as unchanged at 4.4%. This, data should shed light really on that sort of disinflationary story that Powell mentioned and was quite keen to push, actually, if you remember it, in the Fed meeting. And it will come obviously in the context of the HOTS CPI and PPI data as well, which was recently released. We'll look at that very soon. The PPI deflator data, that usually runs a bit lower, a bit below CPI data, but it could also outperform this month as the weakness seen in core CPI was driven by components that don't really impact the PPI estimates. So yeah, we've sort of mentioned then the dollar. We've tried to get into how much more of a rebound we will see. The question really is, the hawkish data that we've seen, does that continue? We've had a lot of blockbuster data, as I've said, so how much more can that continue and then push up yields even further? Now we're sort of pushing towards that 5.5% peak terminal rate, if you like. Really fascinating to see. The flip side, of course, is, well, if we get a long-term downward trajectory, this long-term trend in the dollar, if that then continues, potentially if then global growth and risk sentiment improve. It's also worth bearing in mind, of course, for the dollar, we have obviously this pick in geopolitical risk with the Ukraine 1-year anniversary, as well as obviously China, US tensions really sort of picking up after we kind of thought they were thawing, and we had obviously the balloon saga, if you like, and then the cancellation by the Secretary Blinken of his meeting with Chinese officials, even though he had one over the weekend, I think in Germany, which didn't go so well. So again, you have to remember there would potentially, and we have seen potentially safe haven buying in the dollar just to underpin this support. It's just surprising, as I say, in a way for us that yes, the dollar hasn't broken last week's high at least. Also, another sort of driver potentially around the geopolitical tensions. If you remember, the link between energy prices and asset prices has kind of been broken as gas prices have dropped over the winter. So sort of geopolitical risks may not be so direct or as forceful as they were last year. Okay, just briefly then now touching on just a few bits of data from last week. If I just bring up a graphic, the key data obviously was the January inflation data. That kind of suggested the inflation, this disinflation process, so inflation basically coming down, may be more prolonged, that process, than previously believed. January CPI, that was a 10th stronger than estimates. Headline CPI rose 0.5% month on month. Year on year was 6.4%. And then the core CPI increased by 0.4% month on month, the yearly rate at 5.6%. And a few sort of stats around some of that data. But while the degree of outperformance really is small, it's the details that suggest a firmer kind of path of inflation from the less disinflationary support from, say, core goods, and more persistence from services and food inflation. And I think we've got that chart here. Hopefully you've just sort of tracked some of the stats. Then we do put this chart, this super core inflation chart, which is what the Fed is focusing on. So core, if you remember, CPI strips out the volatile food and energy costs, whereas this super core inflation, not to get too much in detail, that strips out sort of those costs as well as shelter. And you can see the red line is still hot, still high at 7.2%, and that is potentially what the Fed will especially focus on. We also had then data, PPI data, so that's producer price index data, which from last week's, which was surprised strongly to the upside. I think it increased by 0.7% month on month, so well above the forecast 0.2% rise. You also had some of the core PPI data, which was well above expectations as well. And then just thinking of last week as well, again, just highlighting this blockbuster data really, just to point it out. I know I've talked about it before, but always good to look at some of these charts as well. January retail sales was clearly came above expectations, 3%, with core sales at 2.6%, sorry. And as I mentioned, sort of while the warm weather likely contributed to the upside of price, sales actually recovered broadly across all main sectors, and it's kind of consistent with early positive signals from leading indicators. So yeah, a lot of positive data. We mentioned the CPI, obviously PPI, then obviously retail sales as well. And interesting then for equities, which we always like to look at. If you just bear with me one sec, I'll just pull up the S&P chart, which is here. Obviously, we've sort of tracked sideways, really. You can see in most of February, we've had that positive data, but kind of interesting to point out that sort of good news was then seen as bad news, if you like. I think we talked about that before, but whereas sort of generally good news in the data was seen as good for equities, now it's sort of seen as worse for equities, bad news for equities because of the rising interest rates. And yesterday, of course, we had that big breakdown. It was the worst recorded. US equities recorded their worst day in 2 months, actually, on the back of that strong PMI data. And actually, both the blue chip S&P, which is what we have here, and also the tech-heavy Nasdaq. They suffered their steepest daily losses actually since December 15. And we could see then the S&P closed below the psychologically pivotal 4,000 level. And you can see then a whole host really of sort of support levels now that we're hitting. If we just go to the weekly, you can see, just pulling it out, we've got a long-term fib level that we've got here. This is from the 2022 decline. So a 38.2 retrace, that is at 3998. So strong support there potentially. Then we get the 50-day moving average at 3978. And then you've got this long-term sort of trend line resistance, which is now support just below there, which comes in around the 200-day moving average around 39.41. Huge level then, widely watched, the 200-day moving average, plus that trend line support. So yes, sort of 4,000 and just below, sort of 3950 or so, huge support then for stocks for the S&P 500. And something to note, we think. We did have, obviously, as well, we had weak Walmart guidance from yesterday, so consumer stock pessimism, if you like, because we had then Home Depot sales and guidance were both lackluster. That sent their shares down 7%, but both companies really noted shifting consumer patterns to lower priced groceries and goods. And Home Depot actually indicated that wage pressures were still quite excessive. And interesting, really, that could accelerate then the margin compression theme we've seen in stocks, especially then when we get the next earnings, which are out in April and May. Okay, we've gone through some of the technicals. We just look at the Nasdaq as well. Nasdaq 100 this is, you can see the breakdown then, and we're closing in now on that 200-day moving average at 11,912. And then you can see just below that, then we have a fib level, and then the 50-day moving average at 11,689. That's on the NASDAQ 100. Interesting, we think, to pull up the Dow, because we've highlighted consistently this strong resistance level going back to August at 38,281. We've tracked sideways for a number of days. You can see there, if you look on the weekly as well, sort of the number of days, load of doji candles on the weekly, so indecision really. We couldn't crack that big August resistance level, and then we've broken down. And as we've said, the more we track sideways, if you think about it, tighter ranges, the longer those go on, then the bigger we'll get range expansion, the bigger the breakdown or break to the upside will be. And in this case, it looks like it's a break to the downside below the 50-day moving average at 33,620. Which then means, yes, potentially we've got the first level, this January support, 32,948. Then we get the 100-day moving average at 38,824. Potentially we see us challenging probably the December, sort of mid-December lows around 32,581 if this breakdown carries on. So interesting for the Dow, and potential support levels below. Okay, what should we go to next? Let's go to euro dollar. Just bear with me 1 second. I'll just pull up the chart for euro dollar. And again, interesting for us. Well, it slipped slightly this week, euro dollar, but nothing major with this sort of lackluster, in a way, dollar strength for the moment anyway. Losses in euro dollar cushioned by certainly then stronger data that we've seen out of the Eurozone, all point to an improving picture in the region. We had PMI data as well yesterday, of course. France broadly higher than expected, Germany decent. Manufacturing activity that actually weakened somewhat, but generally better data. And then in the composite Eurozone figures, they handily beat estimates. And we also had some German ZEW investor survey sentiment, basically, which improved again as well. So all the solid data sort of, as I say, points to an improving picture, suggests the economy's in pretty decent shape, really, and it gives then the ECB hawks really more sway over policy decisions in the weeks ahead. Of course, contrary to that, on the flip side, we've got this resurgence of geopolitical risk in Russia and Ukraine, and that, of course, is inevitably sort of curbing appetite for the common currency. So technically we've got support around sort of 106.40, 106.60, and then below there we've got a level of 106.10. Really, that's a long-term fib level of 38.2% of the 2021 decline. Actually, that's a 106.10. So tracking just above there potentially, but if we do get a hawkish surprise, say in that Fed minutes, and or say more geopolitical risk being priced in, then potentially that puts that support level at risk. And then we go down, potentially down towards sort of the January low at, where are we, 106.30, sorry, 104.81 potentially if we do lose that 106 support. Yeah, we've had sort of ECB speakers, of course, Schnabel, who's a hawk, well-known hawk, banging the drum about a 50 basis point hike in March, and then more beyond that. But we have had as well speakers this morning actually just saying that potentially markets have got ahead of themselves after the hike in March. Hopefully we've mentioned this before, but certainly we always get, after an ECB meeting, this sort of conflicting views of the governing council. A lot of members, a lot of officials in that, and we have the hawks on one side of course, and the doves on the other, and we always get a lot of noise on the wires with their differing views. But certainly, of course, the data in the Eurozone points to more hikes going forward, and that is underpinning support, even though obviously in Eurodollar we have, of course, the dollar outlook as well to contend with. That's, yes, a brief synopsis, I guess, of where we see Eurodollar at the moment. Also then, let's look finally at sterling cable. We had obviously the mid-month data dump, if you like, we call it, last week that had stronger than expected UK jobs and wages data. The labour market remains really tight. Still, regular wage growth continues to rise. And then we had UK inflation data, slightly different, declined more than forecast in January on lower fuel prices. The headline fell 0.6%. That was actually the biggest 1 month fall in 4 years. And then that pulled down the year-on-year pace to 10.1% against 10.3% expected. And the core fell to 5.8%, I think, from 6.3% and a 6.2% consensus core. So good news that prices are falling, but obviously these numbers are still way too high. Wage pressures remain elevated. And you remember, obviously, the MPC, the Bank of England's target is 2%. So these numbers still 5 times that target. This week, we've had that data out of yesterday. Again, strong PMI readings showing really good, and that's really helped sterling show really quite good resilience, really, even against that re-strengthening slightly in the dollar. We had the PMI data, big and really unexpected jump from sort of contractionary territory at 48.5 into expansionary territory now at 53. That was in the composite gauge, and really kind of favouring a slight re-rating of growth expectations in the UK. And that's then translating into rising bets on the Bank of England tightening. And that has certainly underpinned support for sterling. Take yourselves back, so many bears on sterling, really, that we lose 120 or so in cable, then with going down to 115 sharply. And certainly this positive data has helped boost the outlook for cable because of a re-rating in growth, and then also a re-rating in the bets on the Bank of England. The peak for the Bank of England now, that's jumped by around 50 basis points since the start of the week now, and it falls around 4.5%, just above 4.5% now for the peak rate in UK. That means it's fully factoring in at least 2 more hikes, 2 more 25 basis point hikes. So really interesting sort of difference to what I would say is probably consensus, really. Sterling holding up quite nicely. Another factor to consider as well, actually, is the government borrowing figures. Don't want to get too much into this, but they came in surprisingly short of the OBR's forecast, really, and that gives now the Chancellor plenty more ammunition to deploy fiscal support if he would like. Yes, that's something else to consider and could be beneficial for sterling further down the road. For cable, then we can see we've drawn this mini sort of short-term trend line resistance. You've also got the 50-day moving average at 121.53 there, that light blue line, which could potentially act as resistance. And then for support, well, you've got the 200-day moving average, which we've tapped a couple of times, really. So interesting that will act potentially as quite strong support going forward. That's at 119.33. Also, the 200-day moving average now touching that, close to it anyway, at 119.21, acting as support in cable going forward. I think we will wrap it up there. Hopefully you've gained something out of all that we've been through Today, we've got a lot to look forward to, the minutes and then the PCE data. And then going forward, obviously, central bank meetings potentially in March. I hope that's been useful, and we hope to welcome you back in a couple of weeks' time. Okay, take care out there and stay safe.